Hey guys, hope you're doing well out there. We're back and it's time to kick off earnings season with none other than JP Morgan Chase. I think one of the best companies out there if you want to get a read on the US economy and the global economy as a whole. We'll take a look into their most recent Q1 results, both from a top line and bottom line, but more importantly, we'll take a look at the comments made by CEO Jamie Dimon on basically the US and how the outlook he sees at least panning out over the next little while. And Jamie Dimon, I like to say this, he's basically, think of him as a pilot on a commercial plane cruising at around 30,000 feet, and underneath him is the US economy. The window that this man has, probably no other person in the world has the outlook that this guy has on the US economy as a whole. So when he gets cautious, when he gets a little bit bearish on the US economy, it's important to pay attention to that. And then as always, we'll jump into the technicals for JP Morgan stock. And this company over the last 12 years, really over the past decade, has been a stellar performer, but now reaching the top end of this channel is looking to roll over. So we'll highlight some levels where I think you can get into shares of JP Morgan as a buy and hold investment. Really, this is one that no matter what the economy does, JP Morgan as a consumer bank is probably sticking right there with you. So we'll get into that. As always, if you are new to the channel, be sure to hit that like and subscribe button below. It would be much appreciated. Shares of JP Morgan trading down nearly 6.5% on the day. That is a pretty big move for this bank, considering with the past 1 year, it is still up nearly 42%. And you have one of the most stable companies up nearly 72%. Generally, people see a bank like JP Morgan as a pretty boring investment. But really, if you've held this company over the last 10 years, you've probably done pretty nicely yourself. And you also get a close to 2.5% yield on this. That is growing. Last month, JP Morgan announcing a 10% hike on that dividend. So you get consistent dividend growth. You also get a little bit of a buyback, but more on that later. So revenues coming in at $41.93 billion. That did beat estimates on Wall Street, was good for nearly 9.5% growth on a year-over-year basis. And then Q1 non-GAAP EPS also coming in with a beat close to $4.63. This does exclude a one-time FDIC special assessment charge, which I think JP Morgan and a lot of these US banks like Citigroup, Wells Fargo, and Bank of America were charged also in their Q4, but that FDIC charge continuing to rise. So that was nearly $700 million for JP Morgan. Did affect their bottom line by a little bit, but on a non-GAAP basis, still coming in with a nice 50-cent beat. So the earnings in this most recent quarter coming in with a double beat, so that doesn't seem to be the issue. The issue really lies in the comments made by Jamie Dimon. His comments come as a more cautious outlook towards the US economy. So he starts off by saying the economic indicators continue to be favorable, and that's pretty much where his bullishness ends. As he looks ahead, JP Morgan remains alert to a number of significant uncertain forces, and he outlines those. So the first one being the global landscape remaining unsettling, as you have terrible wars, you have continued geopolitical tensions that are growing. Secondly, you have a large number of persistent inflationary pressures, which he sees at least, that are likely to continue. And lastly, we have never truly experienced the full effects of quantitative tightening on this scale. Basically, interest rates staying higher for longer at this scale, something never seen before. And ultimately, we do not know how these factors will play out, but as a firm, as JP Morgan, should prepare for a wide range of potential environments to ensure that they can be there for their clients. So he basically outlines three reasons: a unsettling landscape with more wars, more geopolitical tensions, higher inflationary pressures for longer as he sees those continuing, and then the full effect of quantitative tightening, so higher interest rates. Those three things he basically sees persistent and are reasons to remain cautious. And he basically had a similar tone last week in his annual letter to shareholders, which JP Morgan released on April 8th. And he basically said the markets should be prepared for more turbulence than what is currently priced in. And he's basically casting a doubt on the confidence of the US economy seeing a soft landing, which is essentially modest growth rates on that GDP, but also declining inflation with declining interest rates. So ideally, we get that soft landing, which I think the markets, at least he's seeing the markets pricing in a nearly 70 to 80% chance of a soft landing happening. But because of the high-end valuations of equities and credit spreads being extremely tight, he actually sees the odds of that soft landing to be significantly lower. He does see there's an enormous focus, in fact, too much focus on the monthly inflation data and the small changes to interest rates, which he actually sees those in the future not really making that big of an impact on inflation. He largely sees the huge fiscal spending, basically in the trillions of dollars needed to grow the economy, as the main contributors to inflation. So the smaller changes in interest rates simply just don't have the same effect on inflation today than they did, let's say, 20 or 30 years ago. And so as JP Morgan, they should prepare for a broad range of interest rates ranging from 2% all the way up to 8% or even higher. Along with that, a wide range of economic outcomes, from really good outcomes of strong economic growth and lower inflation all the way up to stagflation, which he outlined to be the worst case economic scenario. And essentially stagflation is you have slowing economic growth with high inflation, but along with that, you also have high unemployment. And that's really the main data point that is proving to be in our favor. Unemployment rates continue to remain at a relatively historically low level. We look back over the last 70 years of data, and we're still sitting at close to a 3.8% unemployment rate. Again, historically pretty low, but anytime you have these spikes in your unemployment rate, that could lead to a signal of a recession, at least coming over in the US. So you want to monitor the unemployment rate. Ideally, this stays low. That will allow the Fed to keep interest rates higher for longer, at least while inflation remains to prove to be more sticky than it really is. On top of that, though, you do have delinquency rates on your credit cards and credit card loans to continue to rise. This is an economic data that I think is proving to be a bit more worrisome, as it's basically showing the consumer is getting weaker with them not being able to pay off their credit card loans at the same rate. So you have the delinquency rates on your credit card charge-offs rising, and really the last time they were this high was back in 2012. And so once again, we're crossed over that 3% mark on our credit card delinquencies, basically proving that the consumer, at least, is in a pretty weak spot. On top of that, you also have the provisions for loan losses. This is basically the amount of money that these commercial and large equity banks set aside for loan defaults. For loan defaults like a credit card, like a home loan, like an auto loan by your consumer, the banks have to put aside more and more money to cover that loan loss. And as we see, this rate is once again trending higher, which is basically confirming that the consumers are in a much weaker spot, that they're unable to pay off those loans at a higher rate, and the banks have to cover for that. And really, as we continue to see this indicator, if it continues to trend higher, that is another signal that a recession, or at least stagflation, could be in the near future. So I think these are three important data points. I think the unemployment rate remaining low, still proving to be a pretty good catalyst, that the Fed can keep interest rates at least a bit higher in order to wane off that sticky inflation. But if you have continued rising of your delinquency rates on the credit cards, along with that increase in provisions for loan losses, those could be troubling signs, at least for the consumer over in the US. Now, while higher interest rates for longer tend to be pretty difficult for the consumer, at least for a bank like JP Morgan, it allows them to have that steady diet of interest income. And so on the consumer side, we see net revenues climbing nearly 7%. That's pretty strong, coming up to $17.6 billion in this most recent quarter. You did see home lending tick up nearly 65% year over year. And so despite higher interest rates, despite extremely high mortgage rates, you have consumers continuing to take out their home lending loans, probably at this point because they simply have to, because mortgage rates have been higher for quite a while. At one point or another, they have to take out that home loan. But at the same time, you see provisions for credit losses on this consumer side climbing nearly 36% year over year, again, proving that JP Morgan having to put aside more money in order to cover those losses on the consumer side, whether that's on a credit card or the auto or the home loan. JP Morgan at least putting aside more money right now in anticipation for those loan defaults. If down the road the consumers prove to be stronger and they don't default on those loans, these provisions for credit losses will basically flow right down in as a credit onto their bottom line. So right now it's hurting their bottom line, which shrunk by nearly 8% on the consumer side. But maybe down the line, if the consumer proves to be stronger and these provisions for loan losses aren't really used up, those will be released back in and ultimately help the bottom line. So at least the consumer proving to be in a pretty tough spot at the current moment. On the corporate side, though, you have a completely different story. You don't have revenues growing nearly as fast, basically flat on a year-over-year basis. But at the same time, you also have declining provisions for credit losses, as those are basically non-existent. So you're seeing your corporate and investment banking be extremely strong despite having a weak consumer. And so on your corporate side, your net income climbing nearly 8% on a year-over-year basis. Similar story on the commercial side, revenues up 13% year-over-year, all the way up to $3.95 billion. But your provisions for credit losses, in fact, came in as a credit, as JP Morgan releasing nearly $30 million back onto their bottom line. Last year, they put aside close to $400 million in terms of those provisions for credit losses. So overall, while the quarter over at JP Morgan wasn't that bad, actually, if you take a look at the numbers, both from a top line and bottom line perspective along all of their business segments, but I think what you did have was a weak consumer sentiment, basically shown by these higher provisions for credit losses. And then on top of that, you had cautious commentary made by Jamie Dimon, both on his annual letter to shareholders last week, saying that he believes the odds for a softer landing are a lot lower than what the markets are pricing in. And then on top of that, citing the fact that we basically haven't seen the effects of quantitative tightening to the scale before. So I think his commentary really spooking the market, which is why you see a lot of stocks today down, but more importantly, JP Morgan down nearly 6.5% at the current time. But really, again, like we said, over the last 10 years has been a stellar performer. And so you have these periods where JP Morgan stock will decline significantly, but over the long term, I think this is one of the few banks you can keep in your portfolio as a buy and hold investment. Certainly, if you force me to pick up a bank in my portfolio, yeah, I'm going ahead and buying JP Morgan for a fact. Now you are seeing a trend reversal as JP Morgan was close to the top end of this range, basically near $200 a share. This top line of the channel isn't drawn in perfectly. You can likely move it up just a little bit, but close to the top end is where we saw JP Morgan get rejected. Likely I see this one coming back down at least to the middle end of this range, probably the first point where you can step in and pick up shares in JP Morgan, especially if you have no position in a bank like this, probably close to the top end of $150, likely near $158, $160. Probably you can open a position in shares of JP Morgan at that time. Really, that's the middle end of the channel. At that point, you have some levels of support, at least from a technical perspective. And really, as we saw, there's nothing materially wrong with the bank. In fact, Jamie Dimon probably positioning the bank in a pretty strong way, considering he's preparing the bank for a number of outcomes ranging from 2% all the way up to 8% interest rates. And so considering that they are taking all of that into account, JP Morgan probably positioning themselves in a pretty good manner heading into the future. If these shares do continue to head lower from this $157, $158 range, I do expect them to come down close to the bottom end of this channel near the 140s. But at that point, the news will be extremely bearish, at least on the financial media, for a stock like JP Morgan, but likely even across the broader market, the news will be pretty rough. And so at that point, it will be difficult to step in and buy shares of a company like JP Morgan. But keep in mind, the bottom end of this channel is hardly tested, call it maybe 5 times over the last 12 and a half years, where the bottom end of this channel is tested. So that's a pretty unlikely chance I see JP Morgan coming down to the 140s, but certainly at the 160s. And then if it does continue to head lower, I think you can comfortably pick up shares of JP Morgan, especially because it is in an uptrend. That is when you buy the dip in a stock like this. Along with that, you have a growing dividend of nearly 10%, which they announced last month, and then doing a steady diet of share repurchases really anytime they can. And likely from this major drop, you'll have JP Morgan come in there and buy up their own shares. So that was my take on shares of JP Morgan. The results over at the bank coming basically in line to slightly better than what was expected. It's the commentary made by CEO Jamie Dimon that has everyone a bit more cautious, as I think they should be, considering this is a man that has a 30,000 feet outlook on the US and really global economy. I think it's important to pay attention to his words, as it looks like he's really checking the market at a point where equities at least are becoming pretty outstretched. Let me know your thoughts on JP Morgan in the comment section below. We've just kicked off earnings season and we have a lot more to get into over the next couple of weeks. So stick around on the channel, subscribe if you're new, hit that like button below. As always, thanks so much for listening and I'll catch you guys in the next video.